S Corporation Tax General Concepts Problem 7. On January 1st, Year 1, Carrot, an individual, paid $24,100 for 5% of the stock in Root Corporation and S Corporation. In November, he loaned $12,950 to Root Corporation in return for a promissory note. Root Corp generated a $920,000 operating loss in Year 1. How much of his share of the loss can Carrot deduct on his Year 1 return? Compute Carrot's basis in his Root Corp stock and his Root Corp notes at the end of Year 1. All right, the first thing to note is we're dealing with S corporations. We are not dealing with partnerships. The problem suggests S corporation, tax general concepts, and it says that Root Corp is an S corporation. If this was a partnership LLC, we'd have different results because, as many of you already know, when you deal with partnerships, you're able to basically use the entire loan amount, and you're basically able to put that in basis, even if you don't personally loan the business. It's put into one basis amount. Well, here we've got an individual paying $24,100 for 5% of the stock of Root Corp. Also, the individual personally loans money to Root Corp. So the idea with loans for S corporations, the general rule is that you're not able to take into account loans for purposes of determining the tax consequences. The idea there is because a corporation is separate from its owners. If it was an entity taxed as a partnership, like an LLC or a general partnership, limited partnership, you do take into account the portion of liabilities that the partner is responsible for. That's a big difference in the tax law. That can affect things like the amount of loss that can be taken, distributions, things like that. Now, when it comes to S corporations, there's an exception, a special rule, if the owner personally loans money to the S corporation like we have here. So in November, he loaned $12,950 to Root Corp in return for a promissory note. That is a personal loan to the S corporation. In that situation, you can take into account the loan, but you have to keep the loan basis separate from the stock basis. So if it's a problem, an S corporation problem, where you're dealing with basis and there's no loans, no talk of loans or personal loans or anything like that, you just do the basis in the stock. And it's very similar to the rules of partnership where you put the initial cost, the amount in there, and then you adjust it over time for income, loss, gain, deduction that's allocated, and subtract away distributions, those types of things. Okay, that's all you do. For the loan, we keep that separate like we have here. So we have the stock, we're going to have adjusted basis for stock, and we're going to have the adjusted basis for the loan. We keep them separate. All right. I'll get to more specifics, but let's just start with the bases because that's going to be important for this problem. When it comes to the basis, the initial amount here, we're told, on formation, the individual paid $24,100 for the stock. So that's what you use for the stock. Again, you keep that separate from the loan basis. Keep that separate from the loan basis. The loan basis, we start off by saying, okay, and this is all by the way in Year 1. We're going to see later problems where we're dealing with beyond Year 1, additional years. So we have to keep that into account. So you use the amount that's loaned for the basis of the loan. All right. So the question here is how much of the share of the loss, which we're told is a $920,000 loss by the S corporation in the year, can Carrot deduct on his Year 1 return? And the rule, just like partnerships, is that you're limited, holding aside the 465 at-risk rules, 469 passive activity loss rules, and all the special loss limitations, you are limited to your basis, which we are going to consider in this problem. So we first have to calculate, okay, partnership has a $920,000 operating loss, $920,000 operating loss, and our partner, Carrot, all we care about in this problem, right, his share owns 5%. So 5%, or 0.05 times $920,000 gives us $46,000 loss. That is Carrot's share of the loss. So how much of his share of the loss can Carrot deduct on his Year 1 return? All right. So in considering the basis for losses, this is what you do for losses. So for losses, the basis rule, you can use both. Because you're going to see that certain things you cannot use both, like distributions, you only can use the stock basis, you can't use a loan basis. For adjusted basis, for losses, the adjusted basis limit, we consider both stock and loan. So I tell you nothing else in this problem. So that means the question is, can we take all $46,000? Is there a basis limit that applies here? So then we go over to our bases and we ask, do we have $46,000? Well, obviously, if we just have the stock, no, we don't have enough. But if we do the loan, right, 24,100 plus 12,950, that's going to equal $37,050. That's a lot better than 24,100, but still not enough. So what that's saying is we've got, because we can use both the stock and the loan, we've got $37,050 worth of basis from the stock and the loan that we can use. So that means that this year in year one, Carrot can use $37,050 of the $46,000 loss. Of the $46,000 loss. Okay? Of that loss. Now, just like with partnerships, the loss that cannot be used gets suspended to the future, so it can be used in the future if we have basis. Not ideal, but at least you get to use it. And that suspended loss is going to be $8,950 that carries over. Okay, it carries over to the future, and you keep considering it until you eventually get to use it if you have enough basis. Okay, so carries over. All right, so we've got those numbers, carries over, we've got that. All right. So the next question is compute Carrot's basis and his Root Corp stock and his Root Corp note at the end of year one. Well, the idea here is that if we're going to take all 37,050, which is the 24,100 plus the 12,950, we basically are going to use all of that for the loss, because a loss, just like partnership tax, loss is reduced basis. So the loss used reduces adjusted basis. So that brings our stock basis at the end of year one to 0. This is our end basis at the end of the year. The end of the year. And 0. So both of them have a basis of 0. So to recap, there's a $46,000 loss that's allocated to Carrot. The question becomes, can Carrot actually use that on Carrot's return? Well, just like with partnerships, there is the basis loss limit, but the big difference here is with respect to liabilities, you can't put liabilities into basis. However, you can use personal loans in a separate basis, which can be taken into account for losses. So here we add together a 24,100 stock basis plus a 12,950 loan basis. We get $37,050. Not enough to cover all 46,000, but most of it. We can use up to 37,050 of the loss. The remaining 8,950 will carry over to next year and then carry forward after that. After that, if you can't use it until you can use it. The idea there is once you have income, you can then offset, okay, with that loss. And then it brings the basis at the end of year one to 0 and 0. Keep this in mind because we're going to see a few problems where we continue into next year, year 2, year 3, and see how that works. And what you learn from these problems is kind of what you do in these situations where you have a stock basis and a loan basis. Before we leave, I just want to make one point. What if the loss amount was $30,000, which falls between $24,100 and the $37,050? What would you do? How would you do this? Like, what is the ordering? So the rule is that when we reduce the bases down, right? See over here on the left, we've got the stock basis and the loan basis. So if I'm telling you, what if it was the portion of the allocated loss when you do the calculation is $30,000 of loss, and we have $37,050 total. Well, we have enough, right? But it wouldn't be enough just to cover one of them, right? The stock alone wouldn't cover it. We need some of the loan. So the question is, do we reduce the loan down to 0 first and then the stock? Or do we do it the opposite direction? Or do we use some type of proration? The order, when you reduce the basis, when you reduce the adjusted bases of both for losses. So make sure you write this down. It's very important. You would first reduce. Let me take away that circle. Don't want to confuse you. First, you reduce the stock basis down. So we go 24,100 minus 24,100, 0. And then the next portion, which is going to be what? $5,900 would come from the loan. So it'd be 12,950 minus 5,900. And then that balance is what's going to be left in the loan. So that would be second, you reduce. Keep in mind that rule because students, this is something very important. So again, the situation here would be, what if I change around the facts on you and I told you that, it results in a $30,000 loss? Do we have enough to cover it? Yes. So the partner is going to be able, the shareholder, right? I'm just thinking about partnerships right now, but we're dealing with S corporations. The shareholder will be able to take all $30,000 of the loss per the basis loss limits. But the question becomes, well, how do you divvy up that $30,000 of that reduction? Because remember, a loss reduces adjusted basis. The order is, first you reduce stock basis. So it'd be stock basis goes down from 24,100 minus 24,100, 0. And then we have to get to 30,000. So we need $5,900 more, okay? We need, because 24,100 plus 5,900 is $30,000. So then we do the loan, 12,950 minus 5,900, and that gives us 6,000 something, right? $7,050, right? 12,950 minus 5,900 would be $7,050 would become the new loan basis there, and you would be able to take the full thing. So that's how you do this. When you're reducing the basis due to a loss, like this situation, you first reduce the stock basis, you then reduce the loan basis. Now, some of you might be wondering, well, what happens if you increase the basis for income? That's an excellent question, and you're going to see that in the next set of problems. So stay tuned and make sure you go to the next set of problems.